Hello students, welcome to all of you Shiksha 360, and today basically we have to discuss very important topic, that is chapter number 8, that is risk management and the Basel norms. Clear? The risk management and the Basel norm, definitely you will get 3 to 4 questions, even more than that basically in the examination basically from this chapter. Basel norms are very important for the examination point of view, basically Basel 2 and Basel 3. In the Basel 2 basically we have to discuss 3 pillars. Clear? So basically after this session, I will provide you 3 to 4 sessions in the group. So I request to all of you, please go through all the sessions that are related to the Basel norms. And definitely, basically with the help of that session, you are able to score 3 to 4 marks. Clear? At least 2 to 3, not 3 to 4, 3 to 4, basically 1 mark basically from this. At least 2 to 3 marks basically by going through these sessions. Clear? This topic is very important. Clear? Risk management, it is a separate part. Basal norm, it is a separate part. Clear? Basal norms, it is a separate part, and risk management, it is a separate part. Clear? So let's start our discussion. First of all, risk management. Clear? So risk management, basically they are asking regarding what? Clear? So basically banks in the process of the financial intermediation. Clear? Basically banks in the process of the financial intermediation are confronted basically with the various kinds of financial and non-financial risk. Clear? So basically banks are here basically facing various types of the financial and non-financial risk. Example, credit risk, interest rate risk, foreign exchange rate risk, liquidity risk, equity price risk, commodity price risk, legal risk, regulatory risk, reputation risk, and operational risk. Clear? So basically these are the different types of risk basically which the bank is going to face. Clear? Basically either they are going to face financial or non-financial risk. Clear? So some are basically related to the financial and some are basically non-financial risk. Clear? So here basically there are different types: credit risk, interest rate risk, foreign exchange rate risk, liquidity risk, equity price risk, commodity price risk, legal risk, regulatory risk, reputation risk, and operational risk. So these risks are highly interdependent. Clear? Basically these risks are highly independent and interdependent events that affects the banks or financial institution. Clear? So basically these risks are highly independent and interdependent events basically that affects the banks or the financial institution. Clear? Basically that affects the banks or the financial institution. So one area of risk can have ramification basically for other risk categories. So in view of this, basically banks are required to identify, measure, monitor, and control the overall level of risk undertaken by them. Clear? So now let's basically we have to discuss basically at which places basically where what type of risk basically we are going to face and how basically we have to control and monitor them. Clear? Basically, and how basically we have to control and monitor these risks. Clear? So let's start our discussion. So risk management function. Clear? So the risk management function. So what are the broad parameters of the risk management function basically should cover? First one is organizational structure. Clear? Organizational structure. Second one is comprehensive risk management approach. Clear? First of all, basically we have to structure ourselves. That is organization structure. That is basically specific department basically for the measurement of the risk. Then if this is a department, so they have a specific approach. Clear? Comprehensive risk measurement approach. So risk management policy is basically approved by the board, which should be consistent. Clear? Basically, which should be consistent basically with the broader business strategies, capital strength, management expertise, and overall willingness basically to assume the risk. Clear? So sometimes basically they will ask 0.5 mark question in the examination. Basically risk management policy, it is approved to by the. So risk management policy basically it is going to be approved by the board, which should be consistent basically with the broader business strategies, capital strength, management expertise, and overall willingness basically to assume the risk. So guidelines and other parameters used. Clear? Basically guidelines and other parameters are basically used to go on the risk taking. Clear? Basically to go on a risk taking, including detailed structure of the prudential limits. Clear? Including detailed structure of the prudential limits. Clear? So guidelines and other parameters basically are used to go on the risk. Clear? Basically guidelines and other parameters basically are used to go on the risk, including detailed structure of the prudential limits. Strong MIS. So can anyone tell basically what is the full form of MIS? I think all of you have used basically MIS reports basically in your organization. So strong MIS basically for reporting, monitoring, and controlling risk. Clear? Basically for reporting, first of all, basically report. Then you have to monitor, and last one that is control. Clear? Report, monitor, and controlling risks. That is information reports. Clear? Management information system. Well laid out procedures, effective control, and comprehensive risk reporting framework. Separate risk management organization or framework independent upon operational departments. They're independent of operational departments and with the clear delineation of levels of responsibility for the management of risk. That is basically which authority has how much responsibility basically for that risk. It is to be specifically mentioned there. Clear? It is to be specifically mentioned there. Next one, that is periodically review and evaluation. Clear? So basically what are the policies basically they are going to make, so that is basically under the periodically review. Clear? Whether these are suitable for the organization or not. Clear? Basically whether they are suitable basically for the organization or not. Clear? If there is any improvement under that, so basically we have to do also that. Clear? Basically we have to do also that. So now risk management structure. Clear? So now let's discuss basically the risk management structure. Clear? So each bank should set risk limits basically after assessing its risk and the risk bearing capacity. Clear? So each bank basically should set risk limits. Clear? Basically each bank should set basically risk limits after assessing its risk and the risk bearing capacity. Clear? So at the organizational level, the task of the overall risk management basically is assigned to an independent risk management committee. Clear? So basically at the organizational level, basically who has the overall responsibility? The task of overall risk management. Clear? Basically it is assigned to an independent risk management committee. Clear? So basically at the organizational level, basically the task of overall risk management basically it is assigned to an independent risk management committee. So what is the main motive of this committee? The purpose of this top level committee is to empower one group. Clear? The purpose of this top level committee basically is to empower one group with the fuller responsibility. Clear? The purpose of this top level committee basically is to empower one group with the fuller responsibility of evaluating overall risks faced by the bank. Clear? So the purpose of this top level committee is to empower basically one group basically with the fuller responsibility. Clear? One group basically with the fuller responsibility of evaluating overall risk. What is the fuller responsibility of evaluating overall risk faced by the bank? Clear? Basically of evaluating overall risk basically that is faced by the bank and determining the level of risk. Clear? Basically and determining the level of risk which will be in the best interest of the bank. Clear? Basically and determining the level of the risk which will be in the best interest of the bank. Clear? Basically and determining the level of the risk basically which will be in the best interest of the bank. Further, the function of the risk management committee. Clear? The function of the risk management committee are essentially to identify. Clear? The purpose of the risk management committee basically are essentially to identify, monitor, and measure the risk profile of the bank. Clear? So is the function of the risk management committee. The functions of the risk management committee basically are essentially to identify. Clear? Are essentially basically to identify, monitor, and measure the risk profile of the bank. So the committee basically also develops. Clear? Please remember that what are the function of the risk management committee? RMC. That are identify, first of all, they have to identify the risk. Second one, measure. Sorry, monitor. Third one, measure. Identify, monitor, and measure. Clear? So the function of the risk management committee basically are essentially to identify, monitor, and measure the risk profile of the bank. So the committee basically further also develop policies and procedures, verifies the models basically which they are going to develop, like which they have already developed, like basically all span model. Clear? Basically which we have to discuss. All span Z model. Clear? Basically which we have to discuss in the CAB. Clear? All things basically we have to discuss in the CAB also. Clear? Basically in detail at that time, basically in detail. Clear? So these are the different models, like this one is one of the model. The committee basically also develop policies and procedure, basically verifies the model that are used for pricing complex products reviews the risk models as development takes place in the market, and also identifies the new risk, clear, and also identifies the new risk, clear. So as the time passes, clear. So as the time passes, basically there are new risk arises, clear. There are new risk arises. Along with that, clear. Along with that, they have to identify the new risk, clear, as they are continuously development in the market. So it leads to the continuously rise in the risk, clear. So it leads to the continuously rise in the risks. Next one, that is LRM, clear. That is a loan review mechanism, clear. Next point, basically, which we have to discuss, that is the LRM, that is loan review mechanism. So basically, it is an effective tool, clear. Loan review mechanism, basically, it is an effective tool for constant evaluation of the quality of the loan book, clear. So it is an effective tool basically for the constant evaluation of the quality of the loan book and for bringing about qualitative improvements basically in the credit administration, clear, and for bringing about qualitative improvements, clear, basically, and for bringing about basically qualitative improvements in the credit administration, clear, and for bringing about basically credit qualitative improvements basically in the credit administration, clear. So banks have therefore used loan review mechanism basically for large value accounts, clear, basically loan review mechanism basically for whom? For large value accounts with the responsibilities, clear, basically banks have therefore used loan review mechanism basically for the large value accounts basically with the responsibilities assigned in various areas, clear, basically with the responsibilities basically assigned in various areas, such as evaluating the effectiveness of loan administration, clear, with the responsibility basically assigned in various areas, such as evaluating the effectiveness of loan administration, maintaining the integrity of credit grading process, assessing the loan provision, loan loss provision, portfolio quality, etc. Okay? So all things are to be basically gone under the loan review mechanism. That is, first one is evaluating the effectiveness of loan administration, maintaining the integrity of the credit grading process, assessing the loan loss provision, portfolio quality, etc. So what are the main objectives of the LRM? Could be first one is promptly identify the loans which develop credit weakness, clear. Credit weakness, that is basically they have less ability basically to for returning the money back, clear, or for getting their money back, clear. So promptly identifying the loans which develop basically credit weakness and initiate timely corrective action, clear, and basically we have to initiate basically timely corrective action so that basically we will get our money back, clear, so that basically we will get our money back. Second one, evaluate portfolio quality, clear, basically evaluate portfolio quality and isolate potential problem areas, clear, and isolate potential problem areas. Provide information basically for determining the adequacy of the loan loss provision, clear, basically that is basically if there is any loan basically goes to in the loss, so basically we have to provide information basically for determining the adequacy of loan loss provision, clear, of loan loss provision, clear, basically how much basically we have to done provisioning for that, clear, how much basically we have to done basically provisioning for that, that is basically they are saying that loan loss provision. Next one, that is assesses the adequacy of, clear, assesses the adequacy of and adherence to the loan policies, clear, basically assesses the adequacy of and adherence to loan policy and procedures and to monitor compliance basically with the relevant laws and the regulations, clear. So basically assessing the adequacy of, basically we have to follow all the loan policies and procedures, clear, basically assesses the adequacy of and adherence to, clear, and adherence to basically loan policies and procedures and to monitor the compliance, clear, basically and to monitor the compliance basically with the relevant laws and the regulations, clear, and to monitor the compliance basically with the relevant laws and regulations. Further, provide top management. Provide top management basically with the information, clear. Provide top management basically with the information on credit administration, clear. Basically provide top management basically with information on credit administration including credit sanctioning process, risk evaluation, and post-sanction follow-up. Clear? Like this is not going to happen. Like basically we have sanctioned the loan, and basically there is not follow-up basically after sanctioning the loan. Clear? Basically whether they are giving the documents basically from time to time, which is giving after the loan, and whether they are depositing the money time to time, or basically whether they are paying the installments, or if there is any error. Clear? Or basically whether they are running the business properly or not. Clear? So all these things basically we have to done up. That is basically comes up under the post sanction follow-up. Clear? So along with the pre-sanction, clear, along with the pre-sanction visit, that is very important. That is the post-sanction. Clear? Basically whether they are utilizing the funds properly or not. Clear? So basically we have to check all these things. Clear? Basically we have to check all these things that are very important. Clear? That are very important basically for any business. So now move to the next one. So accurate and timely credit grading. Clear? So accurate and timely credit grading is one of the basic components of an effective LRM. Clear? So accurate and timely credit grading. Clear? So credit grading, what it involves. Clear? So here there one word, that is credit grading. So what is the meaning of that? Clear? So credit grading basically involves assessment of the credit quality, that is the loan quality, identification of the problem loans, and assignment of the risk rating. Clear? And assignment of the risk rating, like basically you are taking out the CIBIL or the credit rating of any person. Clear? So basically that is like one of the CIBIL, Equifax. Clear? So basically at that point, basically as per our organization rules. Clear? So basically we have to classify data under the low risk, medium risk, high risk, very high risk. Clear? So basically they have to identify according to that. Clear? So a proper credit grading system basically should support evaluating the portfolio quality. Clear? So a proper credit grading system basically should support evaluating the portfolio quality and establishing loan loss provisions. Clear? And along with that basically establishing loan loss provisions. Clear? So basically with the help of a credit grading system, clear, basically they should evaluate and portfolio quality and establishing the loan loss provision. Clear? And establishing the loan loss provisions. Now move to the next one. Credit risk. Clear? So this is the first risk basically which we are going to discuss here, that is the credit risk. Clear? So what is the credit risk? Clear? So basically credit risk basically it is defined as a possibility of losses. Clear? So what is credit risk? Basically credit risk basically it is defined as a possibility of losses associated basically with the diminution of the credit quality of the borrowers basically or the counterparties. Clear? So basically these losses basically associated with the deterioration. Clear? Deterioration of what? Clear? Basically associated basically with the deterioration in the credit quality. Clear? Basically deterioration basically in the credit quality of the borrowers or the counterparties. Clear? Basically deterioration basically in the credit quality of the borrowers or the counterparties. Clear? So in a bank's portfolio, so in a bank's portfolio, basically losses stem from, clear, basically losses arise from outright. Clear? Basically in the bank's portfolio, basically losses stem from outright default, basically due to the inability. Clear? Basically either the person is not able to pay the money or there is unwillingness. That is willful defaulter. Clear? Due to the inability or unwillingness of a borrower or counterparty to meet commitments. Clear? Due to the inability or unwillingness of a customer or a counterparty to meet the commitments basically in a relation to the lending. Clear? Basically in a relation to the lending, trading, settlement and other financial transactions. Clear? So basically in a relation to the lending, trading, settlement and other financial transactions. So alternatively, basically losses result from a reduction in the portfolio value. Clear? Basically, alternatively, we can say that basically losses result from the reduction. Clear? Losses basically result from the reduction in portfolio value arising from the actual. Clear? Basically losses results from the portfolio value basically arising from the actual or perceived deterioration, clear, basically arising from the actual or perceived deterioration in the credit quality, clear. So alternatively, basically losses result from the reduction in the portfolio value. Result in the reduction of the portfolio value basically arises from the actual or perceived deterioration in the credit quality. So credit risk basically where it arises, clear. So basically credit risk basically emanates or arises basically from a bank's dealing with the individual because they are sanctioning the loan basically either to the individual, corporate, bank, financial institution, or a sovereign. Clear. So basically dealings with an individual, corporate, bank, financial institution, or a sovereign. So basically credit risk basically may take the following terms. Clear. Basically in which forms basically the credit risk basically which is going to be takes place. Clear. So credit risk basically it is going to take place in the following terms. First one is a direct lending. Clear. Basically when you are giving the loan. Clear. Direct lending. That is basically either they are not able to pay the principal or the interest. Clear. That is principal or interest amount basically may not be repaid. Clear. Basically principal and or clear. Either only the principal or the interest or the both. Clear. Basically the amount basically may not be repaid. Second one is guarantees or the letter of credit. Clear. Second one here, that is the guarantees or the letter of credit. Basically, funds may not be forthcoming basically from the constants upon crystallization of the liability. Clear. Upon crystallization of the liability. What is the meaning of the guarantee? Like basically on the behalf of the firm, basically you are giving guarantee to the another firm that if this company basically will not pay the money, clear, of if this firm basically will not pay the money, so on the behalf of the firm, basically we are going to pay the money. Clear. So on the behalf of the firm, basically we are going to pay the money. Clear. That is basically we can say that guarantees or the letter of credits. Clear. So in that, basically if you are giving the guarantee on the behalf of any firm, so basically you are taking any security. Clear. So basically you are taking any security. So that is basically the liquidation of that security. Clear. So liquidation of that security basically will also going take place. Clear. Liquidation of that security basically it is also going to take place. Clear. So credit risk, first one is the direct lending, second one that is guarantees or the letter of credit. Third one that is the treasury operations. Clear. Third one that is the treasury operations. Clear. So the payment or series of payments due from the counterparties. Clear. Treasury operation, that is basically the payment or the series of payments basically due from the counterparties under the respective contracts. Clear. Basically under the respective contracts basically may not be forthcoming or series. Clear. Basically may not be forthcoming or a series. Clear. Series that is stopped. Clear. So the payment or the series of payments that is basically due from the counterparties under the respective contracts. They basically may not be forthcoming or series. Fourth one is securities trading business. Clear. Securities trading business. Clear. So funds or security settlement may not be affected. Clear. Basically security trading business, that is funds or security settlement basically may not be affected. Clear. Basically may not be affected. That is cross border exposure, that is international trade. So the availability and free transfer of foreign currency. Clear. Cross border exposure, that is basically the availability and free transfer of foreign currency funds may either cease, that is stopped due to any reason, or restrictions basically may be imposed by the sovereign. Clear. That is the other country. Clear. So the availability and the free transfer of foreign currency funds. Clear. The availability and the free transfer of foreign currency funds basically may either cease, that is stopped, or restrictions basically may be imposed. Clear. Or restrictions basically may be imposed by the sovereign. Clear. Or restrictions basically may be imposed by the sovereign. So in this way, clear. So basically in this backdrop, we can say that in this way, in this backdrop, so basically it is imperative that the banks have a robust, that is very effective credit risk management system. Clear. So basically in this backdrop, basically it is imperative that the banks have a robust basically credit risk management system which is sensitive and responsive to these factors. Clear. Basically which is sensitive and responsive basically to these factors. So the effective management of the credit risk. Clear. So the effective management of the credit risk basically it is a crucial component of the comprehensive risk management. Clear. So the effective management of the credit risk basically it is a critical component. Clear. Basically it is a critical component of the comprehensive risk management and it is essential. Clear. Basically further basically it is essential for the long-term success of any business organization. Clear. So the effective management of the credit risk basically it is a crucial component of the comprehensive risk management and it is essential. Clear. Along with that, basically, it is essential for the long-term success of any banking organization. Clear. Basically, for the long-term success of any banking organization. So, along with that, basically, credit risk management basically encompasses identification. Clear. So, credit risk management basically encompasses identification, measurement, monitoring and control of the credit risk exposures. Clear. So basically, please remember that CRM. Clear. In every organization, basically there is a CRM section, that is basically credit risk management section. Clear. Before sanctioning of any loan, basically first of all, they will check your file. Clear. Basically they will process the loan file, that is whether basically the person and all the other things, basically they will check. Clear. Before processing any loan. Clear. So credit risk management. Clear. So basically what it takes, so basically it encompasses the identification. Clear. First of all, basically it encompasses the identification, measurement, monitoring and control of the credit risk exposures. Clear. So credit risk management basically encompasses the identification, measurement, monitoring and control of the credit risk exposure. Clear. So this is basically the overall credit risk management. So basically credit risk basically maybe takes place in the following forms. First one basically that is in the direct lending. Clear. First one that is the direct lending. Second one that is the guarantees or the letter of credit. Third one that is the treasury operations. Fourth one that is the securities trading business. Third one that is the treasury operation. Fourth one that is the securities trading business. Fifth one that is the cross border exposure. Clear. Fifth one here that is the cross border exposure. Clear. So in all these things, basically credit risk is going to be happen. Clear. At all these times, basically in all these things, basically credit risk is going to be happen. Now next one that is a market risk. Clear. So now next one that is a market risk. So just basically you have to remember that basically market risk basically where it is going to be happen. Clear. Earlier, basically in the earlier times, basically bank are giving only the loans. So basically at that time. Clear. So basically credit risk management basically was a primary challenge for the banks. But basically with the progressive deregulation, market risk arises basically from which thing, basically market risk arises. So market risk arises basically from the adverse changes in the market variables. Clear. Basically with the progressive deregulation, market risk basically arises basically from the adverse changes in the market variables. Clear. So market risk arises basically from the adverse changes in the market variables. So what are the market variables? Like first one that is the interest rate, foreign exchange rate, equity price, and the commodity price has become relatively more important. Clear. So basically, as with the passage of the time, these all things also basically become more important. Clear. So even a small change in the market variables. Clear. Basically, even a small change in the market variables cause substantial change in the income and economic value of the banks. Clear. So even a small change in the market variables basically cause substantial changes in the income and economic value of the banks. Clear. Like basically if there is a change from the RBI, basically just basically 0.5% in the repo rate. Clear. So basically it leads to the long impact on the banks. Clear. So it's led to the long impact on the bank. How they manage their interest rates. Clear. Basically how they manage their interest rates, or how they put the interest, or basically how they make the interest rate basically on their deposits, so that basically they will attract more and more customers. Clear. So they will attract more and more customers. Clear? So what is the market risk? Basically market risk basically takes the form of. Clear. So market risk basically takes the form of, first one is the liquidity risk, second one is the interest rate risk, third one is the foreign exchange rate risk, that is the forex risk, fourth one is the commodity price risk, fifth one is the equity price risk. Clear. Fifth one is the equity price risk. Clear. So basically market risk basically takes the form of which type of risk. Clear. So market risk basically takes the form of which risk. Clear. First one is the liquidity risk, second one is the interest rate risk, third one is the foreign exchange rate risk, that is the forex risk, fourth one is the commodity price risk, fifth one is the equity price risk. Clear. Fifth one is the equity price risk. Clear. And definitely you will get question basically from these risks. Clear. Please remember these risks properly. Definitely basically you will get straightforward questions. Clear. Under which risk basically what is going to be mentioned, or which what we have going to be covered. Clear. Directly straightforward question basically will be asked in the examination basically from these points. Clear. So in this session basically we have to discuss up to this much point. Clear. Along with the session. Clear. Today I will upload basically 3 videos basically on the basis of the Basel norms. Clear. In which basically Basel 2, Basel 3 along with the introduction of the Basel 1 will be covered. Clear. So I request to all of you, Please go through that to cover all the important points. Clear? So thanks to all of you for joining this session.